So now let's talk about how we get started with credit. We call that establishing credit because you don't just automatically get granted credit. You have to build a credit history. And so you can build a good one or a bad one. And the ways that you can build a good credit history is don't have too much credit. It's not having the credit that becomes a problem, but it's using too much credit. So don't get overextended by using too much credit. Make sure you fulfill all your credit terms, which is primarily paying on time. And if something happens and you can't pay, you would be amazed at how sometimes agreeable creditors can be if you just call them and say, hey, I can't pay. Maybe they'll make special arrangements with you. Sometimes they won't, but if you've been doing all the right things, more likely than not, they'll try to help you out. And be truthful. Don't lie. Just admit if you messed up. And sometimes they'll try to work with you because they'd rather get something from you than nothing. Another way to establish credit is open checking and savings accounts. That shows that you're responsible with your money. And so when you open up a credit account, just get one little card and make small purchases and pay your bill. And so that's how you build up good credit over time. You show that you can use credit wisely. So now the question is, I just said, get a small credit card. Well, how much credit should you get? How much credit can you handle? Well, we can figure this out by using the debt safety ratio. So that means that you take your monthly consumer credit payment, so the credit card payments, divided by your monthly take-home pay. And you don't want that number to be more than 20%. So your monthly consumer credit payment, so we're not talking about a mortgage, that's not a consumer credit payment, should not be more than 20% of your monthly income. So so if we're trying to back into that and figure out, okay, well then how much should my payments be? The maximum is over here at 20%. We said we don't want to go over 20%, but just taking a look at 15 is manageable, 10 is a really low debt ratio. We'd really like to have no debt, but sometimes we have a little consumer credit. And so if your monthly take-home pay is $1,000, then 20% of that would be $200. So you don't want to go over 200. But if you can be under 100, then you would be really safe. You'd have a low debt safety ratio. So then you can just look at the list and see at different take-home pay levels how much debt you can handle. So we're talking about credit in general, but there's credit cards and then there's other open account types of credit. So this credit is extended prior to a purchase, and you can buy up to a certain limit. And so this is offered by retailers and by banks. And so you should get a monthly statement. And if you want to avoid interest, just pay your balance off in full each month. So bank credit cards are the most popular type of account. It's offered by a bank, and so it would have some sort of logo like Visa, MasterCard, or even Discover would be considered a bank credit card. And so your line of credit that they give you depends on your ability to pay. Makes sense, right? And you can take out cash advances or transfer balances from other cards. I don't recommend the cash advances. The fees are very, very high. But a balance transfer may make sense if you have a really high interest rate card and you can transfer that balance to a zero or a low interest rate card. So you want to make sure that you understand all the interest rates and fees associated with any credit cards that you take out. So some examples of fees, high interest rate you can kind of think of as a fee. Annual fees just for keeping the card, it has nothing to do with your purchases. You really want to avoid those. There are a lot of cards that don't charge an annual fee. Transaction fees, those typically are related to those balance transfers or cash advances. Late payment fees, even if it's just a day late, they may charge you up to $40 or $50 for a late payment fee, an over the limit fee. Nowadays, you can tell the credit card company, don't let me go over the limit, because they're approving or declining every purchase that you make. So just let them know, don't let me go over the limit, and then you never incur that fee. A balance transfer fee, we talked about that, and foreign transaction fees. If you use your credit card abroad, you may be charged a fee for that. Special types of credit cards, reward cards. So, like you see on the news or commercials all the time that talk about those reward cards that may give you frequent flyer miles or give you a rebate for a future car purchase or some other type of rebate. The ones I like are the reward cards that count towards college expenses. Affinity cards. Affinity cards are like, if you were a huge UAB Blazer fan, there's certain banks or certain institutions that will let you get the dragon on your credit card. Secured cards are good for people who are just starting out or want to reestablish credit. So what happens there is you have to give the bank money first, and they'll let you make purchases up to the amount that you have saved with them. And then maybe you can graduate to a more traditional card later. Student credit cards will have special promotions for students, maybe low interest because you get good grades or something like that. Retail charge cards. So these are different from bank cards. These are not necessarily Visas and MasterCards. However, some retailers, like the big department stores, now actually can give you a Visa or MasterCard, so you can use that card not just at their store, but at other stores also. But these would be department store cards or specialty store cards, or even gas cards. And so these allow you to build loyalty. Maybe they have some special rewards programs just for that store. But you don't have as much flexibility with these as you do with bank cards. Now, debit cards. These are not credit cards, even though they look like a credit card because they might have that Visa or MasterCard logo. You don't really have a line of credit with them because you're just pulling money out of your own bank account. It's a faster way to access your own cash rather than writing a check. So a lot of people will use debit cards instead of writing checks because it's just far more convenient. But it works the same way as writing a check, so you're going to have to keep up with how much money is in your account so that you don't overdraw your account if you do have some automatic withdrawals scheduled for your account or some checks floating out there. Revolving credit lines now are different from the credit cards that we've been talking about because you may not have a piece of plastic that allows you to access these credit lines. Instead, this is just an agreement you have with a financial institution that says you can draw against this credit line up to a predetermined amount. So typically you draw on your line by writing a check. And so forms of revolving credit, you may set up an overdraft protection so that if you overdraw your checking account, they'll automatically pull the money to cover your overdraft from this line of credit. And so these are typically available just as you need them, or you could have one that's for home equity. And so it's secured by the equity in your house. And so the nice thing about those is that the interest is tax deductible because it's related to your home.